step in. So yeah, it's something people should really, really pay close attention to. And if the banks don't want to lend money to other banks, what does it say about keeping your money within a banking system? What does it say about the systemic risks within the banking system itself? I think people should think about that as well. This is one of the things that we've talked about a lot on your show, is just how safe is the banking system with the change to Universal Commercial Code, with the great taking by David Rogers Webb, with being an unsecured general creditor over the FDIC limit. All of these things we've talked about, bail-ins versus bailouts, for a long time, this is how it would start. In essence, this is where the trouble starts before the stocks get wind of it, before the credit markets get wind of it, before the media gets wind of it. It starts right here because you're talking the most well-informed traders on the planet.
In today's news recap, gold, silver, platinum price forecasts, gold rebounds despite stronger dollar. Gold received support near the $4,000 level and rebounded above the $4,500 level. Despite stronger dollar, if gold stays above $4,050, it will move towards the resistance, which is located in the $4,170 to $4,180 range. Silver climbed back above the $50.50 level as gold to silver ratio pulled back towards the $80 level. A move above the $51 level will open the way to the test of the resistance at $52.60 to $52.80. Platinum made an attempt to settle below the $1,520 level, but lost momentum and rebounded towards $1,540. In case platinum climbs above the 50 moving average at $1,550, it will head towards the resistance at $1,620 to $1,630. Some of the froth has been blown off in a much-needed correction, Rona O'Connell, an analyst at StoneX, said in a note. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Something is happening in my mind beneath the surface of the financial system because over a 5-day stretch over the last 2 weeks, the Federal Reserve injected $125 billion into the repo market. And the popular talking heads would say it was to ease funding stress, as we saw in 2019 with the repo market problems, in 2008 with the fail of Lehman Brothers and the great financial crisis. But it's important to understand that $125 billion, especially over a few days, over a period of 5 days, is akin to crisis-like behavior. It's on par with what we saw when Lehman fell. It's on par to the 2019 blowout in the repo market. But let's first kind of try and dumb down what the repo market is. It's the plumbing of the financial system. And it's where banks, big banks, lend to each other overnight, literally overnight. And they do this to keep things flowing, if you will. Normally, this market, you never hear about it, and that's what it's supposed to be. It's quiet. It means everything's working. But when the Fed steps in with huge amounts of cash, mind you, typically, if there's no stress, you won't see much of any movement in the repo market or usage of it. If there's a little bit of stress, you might see $3, $4, $5 billion put into it, or trading in it. If there's moderate stress, maybe 10, 12 billion. At 125 billion, it's the equivalent of hearing loud banging noise every time you turn your water on in the walls. Something's not right. Something's not flowing right. But what makes this concerning and very different than what we saw in 2008 and 2019 is that in 2008 and 2019, it was an issue of liquidity or lack thereof. Now, this is not a we're out of money problem. Today, the banks the big banks that would trade in the repo market actually have twice the reserves that they had during the 2019 repo crisis. And in this environment, the Fed would rarely, if ever, inject liquidity into the overnight market when reserves are this high. In this environment, repo injection should be near zero. because the banks have enough money to trade with one another back and forth. It's just overnight exchanging collateral, typically treasuries, sometimes mortgage-backed securities or whatnot. But this isn't about money. It's about trust or lack thereof. And in essence, then again, banks are looking at each other and saying, not a chance in the world am I going to borrow anything or lend anything to you, or not even for one night. And because I'm not sure you're going to pay me back tomorrow morning. And the reason this matters is because you typically only see repo market stress right before market corrections. And that's an ominous sign. It's an ominous sign in that this is all about the lack of trust. And when the most well-informed traders on the planet, the very, very large commercial banks, are saying, you know what, I'm not lending my money into this system. I'll just park it at the Fed instead. I am not going to do it. And you start to see the overnight lending system dry up. It portrays, I think, serious fractures within the entire system and is far more concerning than just a lack of liquidity. It's a lack of trust, which is far more systemic and troubling. So, I mean, the banks are trading with other banks, smaller, regional maybe, and also with large hedge funds. And even though, even though you would think that this would be something that should be easy peasy, it's not. And because now it's a lack of trust, it's also a lack of faith in collateral. We've been seeing a lot of subprime and mortgage-backed securities, not subprime, but mortgage-backed securities rather, used as collateral. Now you would do that after you've already, you're doing that because you don't have treasuries or you don't want to trade your treasuries. You're trying to give the collateral that is less than perfect, so they don't trust the collateral and or they don't trust the partners. That is not a good thing because you're trading overnight. You're talking the most liquid, safe, secure trading platform on the planet. You can't get more conservative than trading overnight with the big banks and using a collateral that is, either mortgage-backed securities, which are bundled, or the treasuries. And this portrays that the system itself is rotting from underneath. And the big players know this. It's concerning for sure. And I think people should keep a close eye on it.
In today's news recap, gold deposit accounts in banks nearly double in third quarter. Gold prices hitting record highs have triggered a sharp increase in demand worldwide and in Türkiye, according to World Gold Council data, which reported that global gold demand reached an all-time high in the third quarter of this year. Data from the Banking Regulation and Supervision Agency indicated that gold deposit accounts in the Turkish banking sector doubled during the same period. Gold deposit accounts in Turkish banks surged by 99.1% in the third quarter of 2025 compared to the same period last year, reaching 2.72 trillion Turkish liras. The robust growth was driven by increased investment demand, which reached 537 tons in the third quarter, supported by geopolitical uncertainties and dollar weakness. In the first 9 months of the year, global gold demand was 1% higher, reaching 3,717 tons, equating to $384 billion in value and rising 41% on an annual basis. It noted that the central banks increased their gold purchases in the third quarter, totaling 220 tons of net gold, representing a 28% increase compared to the second quarter and a 10% increase compared to the same period last year. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
You've often told us to trust our gut and to watch for the body language rather than the words. Okay, so for a long time now, ordinary people who are responsible and who don't rely on runaway debt to run their own lives realize, oh, wait a minute, these major institutions that have been able to mark to market their toxic corporate bond portfolio, or excuse me, sovereign bond portfolios that are underwater, or their commercial loan portfolios that are underwater, being able to say, well, they're just still at par value. They're still going to be able to hold them on their books for solvency, to make it look like they're solvent at full value, rather than marking them to market like the rest of us would have to do to tell the truth about where we're really at, or how far underwater we really are. And yet it seemed like suspended animation. Rob Kirby described it as Wile E. Coyote running off the cliff, and he's just kind of hanging out there, and there's nothing under him yet, but he hasn't fallen yet, and he hasn't held up his little umbrella that says yikes yet. But ordinary people with common sense have been feeling for some time, it's like, how long can you keep this charade going on? It seems to belie the fact that it is a charade of liquidity when you have the biggest partners who are well informed, as you're saying, yeah, I'm not gonna say the emperor doesn't have any clothes on anymore. Any further thoughts from you on that before we move on to the next part?
No, I think you said it well. But if this was a problem of lack of liquidity, it would be less concerning to me than a lack of trust. Trust is a hard thing to get back, and the people at the top see the picture better than anybody. They understand exactly just what kind of clothing the emperor is wearing, I guess you could say. And for them to not trade in what is the most conservative, easy trade you'll ever find overnight because they don't trust the system, it's an indictment not just of the trading partners, but of the liquidity or the solvency of the trading partners, and also the value of the collateral. And I think these are two very, very dangerous topics when you talk about what it means. It means that the Fed will typically in this environment be forced to come in and intervene whether they want to or not. And when you already have inflation running much higher than the CPI tells us, we can all feel it with the grocery bills and all of our other bills, and our paycheck not going as far. It could really be if you will, the match that lights the fuse, not only to inflation, but the systemic problems that could chain, domino all the way down if they don't step in. So yeah, it's something people should really, really pay close attention to. And if the banks don't want to lend money to other banks, what does it say about keeping your money within a banking system? What does it say about the systemic risks within the banking system itself? I think people should think about that as well. This is one of the things that we've talked about a lot on your show, is just how safe is the banking system with the change to Universal Commercial Code, with the great taking by David Rogers Webb, with being an unsecured general creditor over the FDIC limit. All of these things we've talked about, bail-ins versus bailouts, for a long time, this is how it would start. In essence, this is where the trouble starts before the stocks get wind of it, before the credit markets get wind of it, before the media gets wind of it. It starts right here because you're talking the most well-informed traders on the planet that are making these decisions.
What do you think of today's show? Is a long consolidation already happening, or is this just a healthy pullback in a mega rally that still has legs to surprise everyone and their mother? Post in the comment section down below your action plan for November, and share with the stackers your price prediction for the end of the year. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.